Alex, is property a risky investment at the moment, given the ongoing uncertainty over Brexit?
I think probably the biggest risk we're looking at the moment in commercial property would probably be within London on Brexit and the uncertainty that's created. But we're also comforted by the fact that the companies we invest in who have got underlying assets in London are also extremely well capitalised in terms of they've got strong balance sheets. So what that means is that if there is a downturn in London, these companies will be extremely well positioned to then be opportunist in terms of picking up opportunities if and when that market weakens. But I think it's also worth noting that the London office market has held up reasonably firmly since Brexit came through. The vote came through on the referendum. And the reason for that is the international investors see London as a very attractive market relative to their domestic markets. You know, they're incredibly attracted to the transparency, the legal system of the London office market. And what that's meant is there's still incredibly strong demand for London office properties from overseas investors, and that's what's ultimately holding the market up at the moment. But if it were to weaken, we believe our companies are well positioned for that. And I think the other point is it also reflects the importance of diversification within the portfolio. And so we don't just invest in London, of course, so we're pan-European, and of course if Brexit were to be a hard Brexit, then we believe that, for example, our landlords in Paris and Dublin, for example, would be beneficiaries of that, although we only expect to be a marginal end of the market, but we think they will be the marginal beneficiaries of that.
And how does rising inflation and interest rates impact a property portfolio?
So we'd expect, if interest rates start to move up, we'd expect to see that some reflected in increased volatility, for example, in share prices of property companies. One of the reasons being is the perception that real estate is an interest rate sensitive asset class. But we'd also highlight the fact that real estate is not a fixed income asset class. And so if we saw interest rates moving up with economic growth, for example, and wage growth, we would see that as a net positive. And the reason being, of course, is that if you saw economies improving with inflation and therefore interest rates going up, we would see the underlying rents increasing. So this would be particularly relevant for our European holdings, for example, where in Europe rents are linked every year, for example, to RPI inflation indexes, for example. So you capture that growth in your top line earnings very quickly. And at the same time, we've also been greatly encouraged by the fact that our underlying companies have been locking in these long-term low interest rates through fixed debt borrowing. So broadly speaking, the quoted property companies in which we invest have got long-term fixed debt. So as and when interest rates were to increase, if that came with economic growth, we think you would see some healthy earnings growth, because of course the top line being the rental income would grow with inflation and economic growth, higher rents, whilst your interest expense would remain broadly flat. So we think that would lead to improving earnings growth and dividend growth from our portfolio.
And where are you finding the best opportunities at the moment?
So we still like the German residential property market, and the reason being is we've done very well out of German residential the last 5 years, but we like the supply-demand dynamics. And the reason being is that the vast majority of our German residential portfolio is valued materially below its replacement cost. So when you have housing valued below its replacement cost, it's uneconomic to build. So the supply outlook is very low. At the same time, on demand, you're seeing increasing household formation in Germany, for example, increasing 1 and 2 bedroom housing, net migration to urban locations. And that's driving the rental growth that we're seeing in this subsector. So we think there's going to be a good outlook to the rental market in Germany. We also like the Paris office market. We like the cycle in Paris. So in Paris, office rents haven't really moved for the best part of 10 years since the last financial crisis. And what that's coincided with is very low levels of supply. So when supply is low and then demand is now picking up, I think there's a lot better confidence in the Paris economy. So you're now seeing corporates increasing demand for space, and that's being met with limited supply. So we're now seeing some rental growth in that market. The other area we like is the industrial market. We like the sheds market and the big urban logistics markets. And the reason being is that the impact of the internet, retailers need these increasing size logistic facilities. So they need to have big box factories to deliver their online offering. And at the same time, they also need to have the smaller sheds, industrial units, in urban locations to meet the demand for next day delivery. So we like that subsector.
Great, thank you very much.
Thank you.